Good morning, everyone. I'm Ernesto Burden. I'm the publisher of New Hampshire Business Review, and it is my pleasure to welcome you this morning to our webinar, Before the Sunset, Estate Planning in Turbulent Times. This webinar is sponsored by Pierce Atwood, to whom we are grateful for that sponsorship. Our speakers today are Marla Matthews, a partner at Pierce Atwood, and Hope W. Martin, CFP, Principal and Wealth Advisor with Vigilant Wealth Management. So let me welcome our first speaker to the presentation. Welcome, Marla.
Good morning.
Oh,
Oops. Do you want me on there too?
Yeah.
I think I should have said, let us welcome both speakers, because
Okay.
I understand that you're going to be collaborating on this. And speaking of collaboration, I do want to mention, as we're going through, audience, please know that you are welcome to collaborate as well by adding questions to the chat. We won't be taking them during the presentation, but we'll have a robust Q&A section afterwards. So there's a Q&A button down at the bottom of the screen where you can type those questions in. And with that, I'll step aside and let you do the magic, Marla and Hope.
Great. Thank you, Ernesto. Good morning, everyone. We thought we would start by doing quick introductions. So as Ernesto said, my name is Marla Matthews. I am a partner at Pierce Atwood. I split my time between our Portsmouth, New Hampshire and Concord offices. And I've been practicing law for about 20 years with a focus on estate planning for about the past 12 or 13 years. And we represent clients all around New Hampshire, general estate planning practice, as well as business succession planning, and some probate litigation as well.
Thanks, Marla, and good morning to everybody. Thanks so much to Pierce Atwood for hosting this, and to Ernesto and his team for the technology side and inviting us both here today. And for all of those of you who are attending, really appreciate your tuning in. Hope Martin, as Ernesto said, I'm a CFP professional. I'm a principal at Vigilant Wealth Management. And I sit in our Portsmouth office, Portsmouth, New Hampshire. We also have an office in Portland, Maine. Vigilant works with families of sort of higher net worth. We work with a smaller number of families so that we have the time and capacity to really go deep in not only the portfolio and investment management, but especially in the planning side of a family's life. Financial life. So that's who I am.
Great, thanks, Hope. The overview of our presentation today is, we don't have a whole lot of time, so we're going to try to squeeze a lot into this. We are going to start by talking about the inciting incident, that's what we're calling this, that has made estate planning, and in particular, making gifts as part of your estate plan, come into focus. We'll peel back the layers on where things stand at the moment. And then we'll move into reasons that you want to do estate planning, regardless of whether estate tax is a concern for you, and how you go about making what I'm going to call a complex estate planning decision. And I'll go into detail about what I mean by that as far as a complex estate planning decision versus basic estate planning. And the importance of having a team to help you with those decisions. And that's how Hope and I teamed up on this together, because we often work together as a team. Hope, obviously, on the investment side, me on the estate planning side, and we find that our clients get a better result when I've had my chance to have input on the estate planning side. Hope gives us a lot of information about what the asset profile looks like and what complex planning might be possible or not possible. And so we hope that one of the major takeaways from today is that you recognize the importance of building a team around you with regard to your estate planning, and that you start at least thinking about building that team. And so we'll start with our slides, and I know Hope is going to kick us off by talking about the theme of our presentation today, which is uncertainty.
Okay. So you should be seeing this slide over here on the screen. Sorry, I'm just going to take a minute to get this all oriented. Marla, do you see the turbulent and uncertain times slide?
I do.
Okay, great, great, thank you. So I thought we would start by really defining the title of sort of the aspects of the title of this discussion, turbulent times. And what do we mean by that? And how does that apply to what your financial and estate planning life looks like? We're looking at, as Marla mentioned, we're looking at the end of this year, the TCJA, the Tax Cuts and Job Acts of 2017, is supposed to sunset at the end of 2025. And with that in mind, there's uncertainty around not only there's income tax provisions that will change potentially, both on the personal and business side. There's also estate tax provisions that are set to sunset. So both of those things provide us with some uncertainty as to how do we plan for this. The changes could be really significant, and Marla will talk more in detail on those in a few minutes. Additionally, on top of that, those changes in the law, we're also experiencing some uncertainty both on the economic front right now, as well as a lot of market volatility. In fact, when Marla invited me to do this, it was March, so it was before some of the most recent volatility that we've experienced. The thing that I want you to leave with today is that there will always be external environmental uncertainty and turbulence. Doesn't matter where you are in time, but by being thoughtful about your planning, you can really neutralize that turbulence. And on the other side of that coin is that a lack of planning can really create more uncertainty within your family, up and down generations, but and even just in your daily life. So we strongly encourage you to control what you can control. And so that's sort of the sort of overall defining moment discussion points for today.
Yeah, and so as we mentioned before, the inciting incident in all of this is the scheduled sunset of the Tax Cuts and Jobs Act. That was enacted in 2017, set to expire at the end of this year. And the way the law was written, if Congress does nothing, then the estate tax exemption, which as of 2025, this year is 13.99 million per person, will sunset to its pre-Tax Cuts and Jobs Act rate. And so before Tax Cuts and Jobs Act, we had a $5 million exemption as indexed for inflation. Under the Tax Cuts and Jobs Act, it went up to 10 million and then has been growing each year based on inflation. So if Congress does nothing, then that act will sunset. And as of 1/1 of 2026, we will have approximately a $7.2 million per person exemption on the federal level. Planning has looked, if anyone on the call works in this realm, or anyone on the webinar, planning has looked much different in the past. Time goes by so quickly, but 8 or 9 months. If we were talking pre-November 2024 election, there was a lot of anxiety about how the election results would impact this sunset. And so we had a lot of clients who were really planning for the sunset And then November happened, and we have a Republican-controlled White House, House and Senate. And so the expectation, at least since November, has been that there will be some sort of extension of the historically high estate tax exemption that we have right now. And just, along the terms of uncertainty, everything happening so quickly in this universe. On Monday, the House Ways and Means Committee released their first draft of their tax bill. And it essentially is an extension of the Tax Cuts and Jobs Act. There's been lots of discussion about including a tax hike on the wealthiest Americans on the income tax front. That is not part of this initial draft. There is language in there that would permanently extend the 37%, I'm sorry, top income tax rate for individuals. It doesn't end taxes on Social Security benefits, which has been talked about, but it does give seniors a boost of a $4,000 bonus, essentially on top of their regular standard deduction. And for our purposes, very importantly, what it does is it raises the estate tax exemption to $15 million per person, then to be indexed for inflation each year. So as I said, that is a first draft, and they began cutting up the bill yesterday. There is a lot of debate even within the House about whether this was a bill that satisfies the more moderate Republicans, but doesn't satisfy some people who want to see additional changes. There is a significant revenue decrease that would come from increasing taxes, or I'm sorry, increasing the exemption and changing the tax code in the way that I've suggested. So how are we going to make up that money is a big question. And even if this passes the House as marked up by the committee by Memorial Day, which Speaker Johnson has set himself the goal of having happen, what happens to this bill in the Senate is completely, I think, still up for grabs. So some of the concerns are that we're raising the borrowing limit in this bill. There have been other proposals floated, such as getting rid of the estate tax altogether so that there wouldn't be a need for an exemption. There would be no estate tax. There's been discussion about, instead of, or maybe in addition to the exemption question, lowering the estate tax rates to match more of the capital gains rates. And estate tax rates, they get up to 40% in estate tax very quickly. So if you have an estate this year of $16 million and you have a $14 million exemption, you pay a pretty significant chunk to the federal government. There's also been discussion about retention of the step up in basis, which this bill that the House Ways and Means Committee is considering does, and we'll talk about how that impacts some complex planning in a second. So keeping in mind, everything is still very uncertain on the estate tax exemption picture. Even if the estate tax was repealed, or we do get the $15 million per person federal exemption, that's all subject to change in the future. It could be reinstated, it could be reduced when a different administration comes in. And so that brings us to the question of, even if there's uncertainty on the tax front, should I be planning? Should I wait and see what happens? And for some people that makes sense. If we are looking particularly at people within that delta between where the estate tax exemption may be reduced to and what it is right now, there may be a desire to do some fairly complex planning right now to reduce the size of your estate. But in my experience, even whether the estate tax exemption goes up to 20 million or $25 million, there are always reasons that people want to engage and should engage in estate planning. And so on the most basic level with estate planning, you don't have to do any planning. You're not required to put together an estate plan. Every state, including New Hampshire, has a statute that says, here's who will get your assets when you pass away. So you don't have to do any planning, and that's how your estate would be divided if you don't do any planning. So that's not really desirable to most people, for the legislature essentially to decide how your assets get divided when you pass away. So most people want to do some basic estate planning. Most people have a concern that their spouse is cared for if the spouse is the survivor, or that their children are cared for if the spouse is no longer living. And so oftentimes people come in for those types of reasons. I want to put together a will and powers of attorney just to cover those types of situations. And oftentimes people say, I want to avoid probate. I've had a bad experience with probate when my parent passed away. And the way we avoid probate is through adding a revocable or revocable, depending on how you say it, but meaning changeable or amendable trust to your plan that takes the place of your will. But more commonly, there are just other non-tax, probate reasons for people to want to engage in estate planning. And so some of those reasons are listed here. People have a family home, maybe a vacation home that's been in one side of the family for generations, and you want to keep that family home in the family as long as possible. And or you might want to move the value of that family home out of your taxable estate for tax purposes. So there can be dual goals or role or purposes in creating a trust, for example, or a gift of a family vacation home. We often hear from clients about creditor protection. Most common example is my son is now married and I like their spouse, but I'm a little worried if they get divorced that, my child's inheritance would actually go to the spouse. And so there are things we can do in your estate plan to provide for all types of creditor protection. That might be from divorcing spouses, that might be from other creditors. New Hampshire, as many of you I'm sure know, has a very, very flexible trust law and progressive trust law. And so there are a lot of things we can do to protect assets from creditors with certain limits. We also deal a lot with business succession planning. So New Hampshire Business Review, many of you are interested in businesses, own your own small businesses or large businesses. And you get to that point in life where you're at an inflection point. Maybe you have several children and one child is really involved in the business, or maybe you don't have a person who is there to take over the business when you pass away. And so business succession planning and estate planning go hand in hand. We've recently been working with several business owners on setting up a trust to hold some business interests for them that acts as a construct for how those interests are going to be passed to the next generation. And the purpose of the trust is to keep the business going for as long as possible, but also to acknowledge that different family members may have different interests and desires regarding the business in the future. So that's something that your estate planning attorney, as well as your financial person, your accountant, can really be key in helping with. And then there are beneficiary specific concerns. I have a niece who has special needs and I want to leave her something, but I don't want it to interfere with her ability to have public benefits be available to her in the future. So sometimes, and then sometimes you have a family member with an addiction problem, and we can build those, address those concerns, I should say, as part of your estate plan. And then there's leaving a legacy and charitable giving. People are nowadays more often wanting to include the next generation in those discussions and share what they have been doing and what's important to them and what their expectations are in the future. And that's, estate planning can help to address that. Maybe not completely address it, but can help. And then we often have blended families, and estate planning is key in that situation. If I am in a second marriage and I have children and my spouse has children, maybe I'm a little nervous that if I pass away first, then my spouse has control over all of the assets. And if unexpected circumstances happen, maybe my kids aren't going to be entitled to my inheritance. And so planning around that is very important. And so once we have that conversation, the question comes up, well, how do I do that? And this is where we get into the more complex planning. And so when I say that, I want you to think about complex planning really being moving assets around in your estate. And that may be gifting. So it may be, I'm going to make an outright gift of cash to Hope of $50,000. And I've gotten that out of my taxable estate because Hope is now the owner of that. But usually we're talking about a business or a business interest or that family vacation home. And how do we gift that asset from the perspective of getting it out of your taxable estate while still giving you the income that you need to live on, and having the control, if it's a business interest, that you want to have going forward, with the dual goal of moving the appreciation of those assets out of your taxable estate. And so often when we're talking about complex planning, it's gifting. And when you come to me or other estate planning attorneys in New Hampshire, we have this questionnaire that we like to have you fill out. It gives us a lot of family information. It gives us the summary of your financial assets. But when I start to have that gifting conversation with people, sometimes the response I get is, well, either I'm not ready to give up control of that asset, or more commonly, I would like to gift and I would like to reduce my taxable estate, but I don't know if I'll have enough money to live on. Or which asset should I gift? Because with gifting, what we want to take into account is what the value of that asset that you're gifting was when you acquired it, and what the value of the asset is now. And so when you pass away, any assets, appreciated assets that you have in your estate, get what we call a step up in basis. So if I bought Apple stock for $10 and I die owning that same Apple stock and it's worth $1,000 a share, my beneficiaries get to take that stepped up value if they are to sell those assets in the future. When I gift an asset during my lifetime, we don't get that step up in basis. We get what we call a carryover in basis. And so when I start that conversation with clients about gifting, Some of the roadblocks, as I said, are, well, I don't know if I'll still have enough money to live on, or I'm interested in gifting, but I don't know what assets that I should gift. That's where I really rely on somebody like Hope to step in and to say, these are the assets. This is the income the person needs. I never know that. And how do we make this all work? And I recently had a meeting with clients where we brought a whole team together. The wife was considering making a gift of some of her business interests, and they're fairly young, and those assets have appreciated. And we had quite a long conversation with the whole team about whether it made sense to gift those assets now or to hold off on gifting to see what happens with the estate tax exemption and all sorts of other growth in their estate that may happen between now and then. Or should she hold on to those assets so that the beneficiaries of her estate actually get a step up in basis if they're likely to sell those assets in the future? And so this is where Hope comes in and helps us analyze all of those issues. And I'll let her talk a little bit about how we might have an idea of what we want to do, but Hope really helps us shape exactly what that should look like.
Yeah, that's actually a great sort of setup story for this. That conversation with the families, it really is a conversation, and what's nice is that what I've enjoyed in working with you, Marla, as an example, is the ability for us to look at really on my side deeply what the income sources and income needs are, and then have you sort of be the architect of how to achieve the best outcome, the optimal outcome for the generation, usually Gen 1 generation, first generation, who have started a business, for them to continue to have their own needs, but also understand how who can benefit from gifting into trust, for example, and to what extent. So these conversations are really important, and the conversation, you and I talked about how the team can be, it is composed of both attorneys, CPAs, folks like myself, but also family members up and down a generation. So, and sometimes in certain families that we serve, we have families that are up, down, and sideways. So there are often siblings or cousins involved, and all of those inputs are important, and very much worth the time to spend to craft a plan that reflects everybody's needs and wishes. The slide I'm showing you here is the wealth life cycle, and it's where I want to start because families experience their wealth life cycle uniquely, but essentially it can be boiled down to accumulations, these three stages: the accumulation stage, consumption, and distribution. And in accumulation stage, you're building your balance sheet, you're saving for retirement, you're thinking about how do you make sure that the dollars are there when you need them, when you're not earning anymore. Then you move into the consumption stage, where you're protecting your balance sheet. You're perhaps no longer earning income from your job, but you're going to rely now on the portfolio of retirement assets, as well as perhaps taxable assets that you've accumulated over time during your accumulation phase. And then starting to think about the distribution of your estate. And this is where really the rubber hits the road for Marla and me as we work together, where we do want to craft the best plan to transfer the wealth and also the knowledge that one generation has built up. And I think, just structuring these things well is bound to make you successful in the end across your family generations. So how do you do that? So there's a variety of topics that we do a deep dive on with the families that we serve. I'm showing you them all here, but for today's purposes, given our time constraint, we'll just talk about the three that I've circled here and highlighted. The first one being the overview of financial assets. So basically your balance sheet, your personal balance sheet, where you gather the information of what you own and catalog that in a balance sheet. Secondly, the cash flow planning, which is pretty self-explanatory, understanding your income sources, your income needs. This includes taxes, it includes business interests, anything that has to do with cash flow planning. And then lastly, estate planning. So really deep dive into all three of these is essential. And then as well as for another day, the other topics as well. But my hope in today's discussion is that you come away with some clarity in how to do this. What are some of the essential items, and then how do you do this? This will hopefully give you some clarity as you encounter transition, whatever that transition is. So regardless of where you are in that wealth life cycle, the first thing you need to do is build your personal balance sheet. So you're simply cataloging what you own. That can be financial assets, real estate assets, whether it's commercial real estate or personal real estate, and then also business interests. And Marla referenced a couple of scenarios where business interests can be it's a deep discussion about what do I want to do with this business if I'm a private business owner. If it's a family business, how do family members figure in these plans? But we'll talk about that in a minute. So the other piece of the balance sheet is what you owe. So what are your liabilities? You may have a mortgage, other debt of any sort. So, and then how are those things titled? Importantly, and this is what Marla was talking about, is the titling of your assets and guidance around the titling of your assets is very important because it governs what happens to your estate after you're gone. And if you do some estate planning, you can really unlock some incremental value to optimize the outcome of what happens after you're gone.
Yeah, and I think just to chime in here, Hope, we talked a bit about whether you title assets in trust to avoid probate, but your first bullet under how is it titled is really important because I often have clients come in and they have a joint bank account with a child, or they have a joint investment account with someone, and when a person passes away and you are joint owners of an account, the surviving owner automatically has legal title to that account or that asset. And so I know people often will say, well, I'm going to rely on whichever child is the joint owner of that account, and they're going to divide it among everybody like I've told them to. That makes me very nervous because there's no legal obligation for the joint owner to do that. And so I'm really glad you put that on the slide because there's some misunderstanding sometimes about how those assets will pass.
Exactly. The important thing to do is also review these things annually. Make sure that if it is a joint account, does that still make sense? You really want to make sure that the titling in your balance sheet reflects your wishes. So I say that's a first step, and it can be a little bit overwhelming to start, but it's actually fairly simple. And the goal of doing it is so that you gain clarity of sort of what's the landscape of your financial life. And once you have clarity of this, you can gain more control and then more confidence. That's what we want. We want control and we want confidence, especially in the face of uncertainty. So what I'm showing you here is just a sample of the net worth statement or personal balance sheet that we will typically build with a client. It might be a little small, so I'll try to make it bigger. But it's pretty simple. You're cataloging your assets, breaking it out into taxable assets, your typical brokerage accounts, your retirement accounts, your residential real estate, commercial real estate, business interests, and then write down the value and then write down the title next to it. And then you have it all there in front of you and you know what it is. You know what your basic structure of your financial life is. So in this case, I'm just going to quickly point out that you can see that there are business interests at the bottom of this page. This family has retained some of the business in their own personal estate, but they've already gifted a big portion of their wealth out of their estate by way of these irrevocable trusts at the bottom of this page. Just so if that is the case, when you're structuring your balance sheet, just make sure that you're aware of which assets that you have in your estate and which assets that you've already potentially gifted out of them if you have done some planning. From there, once you have a sense of what your balance sheet looks like, you can now really dig into what are the income sources and needs that you're going to derive from that balance sheet, right? So we talk here at Vigilant, we talk a lot about the client's liquidity equation. And I'll reference back again to Marla's discussion about the family business, where you have one generation who started the business, then you have the next generation. Maybe some of the kids are interested or already involved in the business and some are not. There are different types of stakeholders in any given business, including the founders. And where it may make sense for a founder to relinquish control of the business in order to plan for their estate or relinquish ownership, I should say, of their business. There are ways that Marla can craft the plan such that a Gen 1 owner of the business can still maintain cash flow from that business and solve their own liquidity needs, but allow for the passing of the value of the business while we're in an elevated estate tax exemption amount today. So that's just something that I wanted to point out. Additionally, asset location and asset allocation is obviously important when you're thinking about your cash flow planning and eventual disposition of your assets. So when we talk about asset location, we're talking about what types of assets are in what form of ownership today, and what types of assets will you gift down to the next generation, both upon death and during your lifetime. There are income tax as well as estate tax implications to both of these decisions. But the important part is to determine whether you've got adequate sources of income for yourself, as well as passing on to the next generation, and that they're invested appropriately. So this diagram kind of essentially shows a diagram that we like to build out for our families and as essentially a graphical representation of the balance sheet. So what I'm showing you here is the total estate is around $25 million of both John and Mary. John's taxable estate is broken up into these buckets that you see here across the first row. He owns some things jointly with his wife in the black and gray buckets or boxes. The blue boxes represent the things that John owns personally and has the opportunity to select where are those going to go. And then the purple boxes show what is owned right now by way of, these are business interests, so commercial real estate and business interests both. The discussion that you need to have with your family members, once you get this laid out, is how are you going to want those assets to flow down to your family members? Because taxable assets can be the difference between the tax implications of inheriting investment accounts versus IRA, Roth IRAs, or traditional IRAs versus business interests. That has implications both in today's tax as well as your next generation's inheritance. So we like to look at, in this scenario, we're showing that the bank accounts, the investment accounts, personal property, business interests, Roth IRAs, these are things that can stay in your estate and that are good things to pass on to the next generation, depending on their tax brackets. Irrevocable trusts, you may put business interests and other investment accounts. Real estate, Marla mentioned maybe family real estate that you want to keep in the family, but you need to provide some liquidity to, or some governing rules around how the family members in the next generations will utilize and fund that real estate. So often people will put that real estate into an irrevocable trust. And then for charitable purposes, thinking about utilizing traditional IRAs to fund a donor advised fund or a charitable trust. Well, you wouldn't use the IRA for that, but the funding things that can be tax optimized in your charitable plan is also an important discussion to have. So the last slide I want to show you is, again, this is more of the cataloging kind of element to an estate plan. And that's where I referenced earlier, you really want to make sure you're reviewing your plan periodically. What we do, we create this table for clients so that they can look every year at what documents they have. This includes the will, any trusts that may happen upon a testamentary trust that happens upon death, and understanding for each person in the couple, who are the successors, who are the successor trustees, who are the executors. When you die, who's taking care of you and taking care of your affairs? If you're sick or incapacitated, who is your power of attorney, and does that still make sense? So when we talk about building the team, it's really important that you include not only a conversation with your professionals, but also your family members. Does it make sense to have both children be your healthcare power of attorney? Maybe not. Does it make sense to have your sibling who is older than you and not in good health continue to be named as your executor or your successor trustee? Maybe not. But how do you deal with that question? That's an important aspect to the conversation too. You have to bring in your other family members or the people who are close to you. It doesn't necessarily have to be a family member, in order to have these discussions so that everybody understands what the plan is, or at least so that you understand and you're comfortable with what the plan is. So that, and that kind of brings me to our last slide of building your team.
Yeah, and I'll pick up for a second, Hope. I think that, as you mentioned, your family members and the next generation might be part of your team. I think in New England in particular, we were brought up to hold things close to our vest, as far as, our financial plans, the amount of money we have. And so what we're encouraging you to do is sort of to get over that and to build a team that's going to work for you. And you know, obviously you want people who have the expertise on the financial and the investment side for Hope, on the estate planning side, on the income tax side for your accountant. If you have business interests, the corporate attorney is important to bring into that discussion. But I encourage people, and I mean this wholeheartedly, to build a team is the best way to say it, that fits your personality. You know, I've said to Hope before, I'm not everyone's cup of tea for an estate planning attorney, and that's okay. There are other attorneys out there. And I encourage you to find someone both on the financial side and on the planning side to have someone who you are comfortable sharing all of this information with. As in our positions, we get a lot of really personal information about your finances and about your families. And so you have to have someone who's not only competent, but who that you are going to enjoy working with. And you know, for example, for me, if you want someone who's a very hard charging personality, I'm not your cup of tea, but there are those people out there, and we encourage you to explore that. And the question of the family meeting and bringing in the next generation, I think, is very personal. I meet with clients all of the time who say, I don't have to tell anybody about this, do I? And that's okay. There's no legal requirement that you have to tell everybody. And then I have other clients who say, now that we've finished up this plan, can we have a meeting with you and Hope and our kids so that everybody understands where this is going to go in the future? And so you really need to have people that you're comfortable working with. And I guess the last thing I'll add is just as a second takeaway to building your team is really to just think carefully about your planning, whether you think you have an estate tax concern or not. And don't be swayed by the hysteria that surrounds us nowadays into doing some complex planning that you're not comfortable with. You really only should go ahead with complex planning. And by that, I mean the gifting to people or to trusts that you're already inclined to do. Because if you, for example, at the end of 2012, the exemption was scheduled to come down similar to how it is this year. People did a lot of complex planning, gifted assets out of their estate, and then the exemption stayed very high. And there was some buyer's remorse there. And so having a team to bounce ideas off of, and just thinking very carefully about whatever you do. And as Hope said, having the control and confidence over your plan is going to help you no matter what happens in the future. And I think, Hope, unless you have anything else to add, I'd kind of like to leave you with that thought.
No, I think that's great. I think those deep discussions and thoughts about deep thinking about who your team is important. And yeah, so I guess that we are ready to take questions if there are any questions.
We do have questions. So thank you, Hope. Thank you, Marla. I'll just say on behalf of Business Review and our audience, you are the perfectly steeped cup of tea for us today. We have some questions from the audience, and I have some questions. I want to start with one that was pre-submitted by email. The question was, after studying about trusts, my understanding is that revocable trusts only protect my assets while I am capable of caring for myself and making my own decisions. In order to protect my assets, if I become incapacitated, my understanding is that I must transfer my assets to an irrevocable trust and thus relinquish full control over the decisions related to my estate. Is there any other option to protect my assets from state or federal government access, such as Medicaid absorption, should I need 24-hour care someday?
Yeah, good question. I like to encourage people to think of their revocable trust or revocable trust as a pass-through entity. So you have control over the assets just like you do now if you own them. So from a creditor standpoint, and this includes Medicaid coverage, if you have assets in a revocable trust, there is no creditor protection for them because you own them. You can control everything in that trust. So we do, if we are looking at protecting particular assets from creditors, whether that be Medicaid or maybe you're a surgeon and you have very high liability in your practice, we are looking at gifting assets out of your estate. That might be an outright gift to someone. It doesn't have to be an irrevocable trust, but an irrevocable trust, as long as it's set up right and it is administered appropriately, can move assets out of the reach of creditors.
Okay. Should I move on, or Hope, did you want to touch on that at all?
No, that is squarely in Marla's. I guess,
All right.
well, the only thing I would say on that is when you're moving those assets out of your estate, if they do go whether it's going to an irrevocable trust or somewhere else, the important thought process is understanding that you're relinquishing control, and in theory, in the IRS, in the eyes of the IRS, the dollars associated with those assets therefore have to be arm's length from you. So again, that discussion about how do you turn on an income stream from somewhere else other than those assets is an important consideration to have.
I feel like this is a natural time to segue to the next audience question, which was, does it make sense for a healthy 72-year-old woman to move assets, complex estate planning, even when one's net worth is just, she also used quotes there, just $10 million because of uncertainty with future administrations?
And that's the gamble. I promised Ernesto that I wouldn't do any fortune telling. So I would say I have, again, not fortune telling, but historically, the exemption has never been reduced. So in my view, and I think in the view of many other experts in the field who have far more experience than I, the exemption is likely to continue at a fairly high rate. I think it depends on your personality. And whenever I meet with clients, whether it's about tax planning or whether it's about basic planning, I tell them that my ultimate goal for them is for them to sleep better at night. And so if you are going to be staying up at night worrying about whether you should take advantage of this now, maybe you do move some assets out of your estate because it's going to make you feel more comfortable. It's really a personal decision, which you have to balance against the probability that the estate tax exemption might stay high. The other thing I will add is that almost everyone in Congress has skin in this game. So keep that in mind too. Everyone has an estate. Many people probably have taxable estates. And so we have that as far as the estate tax exemption reduction going for us as far as that high number continuing.
Oh, thank you. Yeah, and I mean, in terms of that, not predicting the future, that seems to strongly say, while you can't predict the future, what you do know is what is happening right now and what is happening internally for you right now.
That's right. That's right. And some people, as Hope said, have another income stream. So it makes sense to gift part or portion of their estate to get it out of their taxable estate because they're going to be just fine given the assets that they keep in their estate. that might not be the case for everybody. You know, everybody's book looks different. And again, what's going to make you sleep better at night?
One of the things, as we got towards the end, you talked about building the team and you gave some guidelines around what to do. What about what not to do? What have you seen in the past that has been a good illustration of here's why not to do this when you're building your team?
Hope, do you want to go? I go.
Sure. What not to do when you're building your team? I think it's important not to make quick decisions. It's really important to understand the nature of the person you're dealing with, and do they really have the ability and time to deliver the value that they say they can. A lot of times the sheen is really nice and attractive, and but you need to spend time doing all of this planning. So I think that's important to be mindful of the time that this needs to be given.
Yeah, and to add to that, I would say, I can imagine that, you know, when we say you have to build a team with all these different professionals, that puts some people off as far as expense, and time. And I completely understand that. But the cases where I've had clients, there aren't many, thankfully, but a few cases where people have made a rash decision because the exemption was coming down and gifted assets out of their estate. We didn't have any other, they didn't have other advisors involved. And so they, you know, there was a bit of buyer's remorse there. And so I think not building your team is where it can go wrong.
Does it get
Yeah,
sensitive
great
when you're
point.
building that team, including, you know, part of that team you identified was family members, and there must be expectations amongst family members about who's going to be included and who's not, and a sort of domestic politics to navigate there?
Absolutely. And I think that is why some clients choose really not to involve family members. And it's really on a case by case basis that it might be best not for the client. It might be, it's going to make them sleep better at night to know they're going to keep the peace while they're here. And maybe people deal with it when they're gone. If people are unhappy about a decision they've made, that might be the case, but I find that in many instances, you know, people want to share with their family what their plan is and feel that it's better to have people know that up front.
One of the ways that we experience this is where we work with the parents typically who have a lot of money, and they have young or growing or newly adult children, and or even kids in their 30s and 40s. And as they contemplate their own plan, as they work through it with our help, we sit with them and work through that. What we see a lot that's helpful is we'll bring in the younger generations when they're ready to talk about the concepts and the structure, but we don't need to talk about the dollars. We can have really important and helpful and illustrative conversations with family members who need to know what the plan is and have input into it, but they don't need to know the dollars, really.
Interesting. Well, great points, and we have crossed the threshold at the top of the hour, and so I should thank you. This has been a wonderful presentation. I'd like to also thank Pierce Atwood for sponsoring, and of course, thank our audience for being here today. It was a pleasure. Look forward to next time.
Thanks,
Thank you.
everybody.
Thank you.